In recent monetary history, few events have captured the attention of market observers and currency analysts, quite like the sudden shift in Iraq's official exchange rate. For months leading up to the policy shift, senior officials at the Central Bank of Iraq publicly denied that any change to the national currency value was on the horizon. Statement after statement reassured the public and commercial markets that the existing exchange framework would remain intact. Yet, almost overnight, the official exchange rate moved from approximately 1,450 dinars per US dollar down to approximately 1,310 dinars per US dollar. This decision sent immediate ripples through domestic markets, global currency commentary circles, and international financial institutions observing Iraq's macroeconomic trajectory. What makes this event particularly significant from an economic standpoint is not merely the size of the adjustment, but the exact mechanism behind it. Contrary to persistent rumors that circulate across online forums and social media, this move was not triggered by foreign legislation such as a Domestic Clarity Act, nor was it forced by new bills passing through the United States Congress. It was not the result of a global cryptocurrency event, a secret international monetary accord, or an external reset protocol. What occurred was simpler, far more conventional, and fundamentally sovereign. A national central bank exercised its legal authority to adjust its official currency benchmark, based on internal fiscal priorities, macroeconomic calculations, and foreign reserve dynamics. To understand why this happened and what it means for anyone following the Iraqi dinar, we must first break down the mechanics of central bank communication and sovereign monetary policy. In central banking worldwide, public statements regarding exchange rates are managed with extreme caution. When a central bank is considering a currency revaluation or devaluation, officials will almost always deny those plans publicly, right up until the exact moment the policy takes effect. The reasoning behind this strategy is practical rather than deceptive. If a central bank announces weeks or months in advance that it intends to strengthen its national currency, market participants will immediately hoard the currency, halt international trade, and engage in rapid speculative arbitrage. Conversely, if a central bank signals a devaluation in advance, capital flight occurs instantly, as citizens and businesses rush to sell the domestic currency for foreign reserves. Therefore, official denials ahead of major exchange rate adjustments are a standard operational tool used by monetary authorities globally to maintain market stability and prevent systemic panic. When the Central Bank of Iraq executed the shift to 1,310 dinars per dollar, it was acting within its mandate to manage domestic inflation and align monetary policy with state fiscal goals. At the time of the adjustment, Iraq was experiencing heightened domestic price inflation on imported basic goods. Because Iraq relies heavily on foreign imports for everything from food and textiles to construction materials and electronics, a weaker dinar directly translates into higher grocery and retail prices for ordinary Iraqi households. By officially strengthening the dinar against the dollar, the central bank aimed to reduce the land cost of foreign imports, effectively using exchange rate policy as a direct shield against imported inflation. However, examining the official exchange rate is only one side of a complex two-sided financial picture in Iraq. To truly evaluate the Iraqi dinar, one must examine the relationship between the official central bank exchange rate and the parallel market rate, often referred to as the street rate or exchange office rate. When the central bank set the official rate to approximately 1,310 dinars per dollar, official state transactions, government imports, and verified commercial bank transfers were cleared at this rate. Yet across local exchange markets in Baghdad, Erbil, Basra, and Sulaymaniyah, the open market rate often continues to trade at a noticeable premium, frequently hovering at higher levels, such as 1,450 to 1,500 dinars per dollar, depending on local dollar liquidity and commercial demand. Understanding why this spread exists is essential for anyone analyzing Iraqi economic data realistically. The divergence between the official rate and the parallel market rate is driven largely by strict international compliance standards and domestic cash demand. In recent years, the Central Bank of Iraq, in coordination with the United States Treasury and the Federal Reserve Bank of New York, implemented enhanced anti-money laundering and countering the financing of terrorism protocols. Under these modern compliance mechanisms, commercial banks requesting US dollars through the official foreign exchange auction must provide detailed, verifiable documentation regarding the final destination of those funds and the underlying commercial trade contracts. For legitimate, fully compliant importers, the official rate of 1,310 dinars per dollar provides access to lower-cost foreign exchange through the official banking system via SWIFT transfers. However, smaller traders, informal merchants, and entities unable or unwilling to meet international banking compliance requirements cannot access the central bank's official dollar pool. Instead, these entities must purchase physical US dollar cash on the informal street market. This ongoing demand for physical dollar bills outside the formal banking system creates a persistent gap between the official policy rate set by the sovereign bank and the actual market rate available to everyday cash traders. From a short-term economic perspective, the official revaluation delivered both tangible benefits and structural challenges within Iraq's domestic economy. On the positive side, state institutions and major formal importers experienced immediate purchasing power gains. State-funded development projects, public sector import procurement, and essential commodity purchases became less expensive in dinar terms, alleviating pressure on the federal budget. Additionally, for Iraqi citizens receiving government salaries, a stronger official dinar helped stabilize the baseline cost of essential subsidized goods, providing relief against global supply chain cost increases. On the challenge side, the immediate short-term friction manifested in the parallel market. Small business owners who purchase inventory using physical dollars bought on the street found themselves facing higher procurement costs relative to the official benchmark. This created temporary distortion in retail pricing, where prices for non-subsidized goods did not fall as quickly as the official rate change would theoretically suggest. This lag between official central bank policy changes and real-world retail pricing is a common feature in developing economies transitioning from cash-dominant informal systems to structured, compliant banking frameworks. Looking at the long-term economic implications, the sovereign adjustment to 1,310 dinars per dollar marks an ongoing structural transformation within Iraq's overall economic trajectory. Iraq's monetary stability remains intrinsically tied to its primary export commodity, crude oil, because Iraq sells its crude oil on global markets in US dollars. The Iraqi Ministry of Finance receives vast revenues in foreign currency, which are subsequently deposited into account reserves, managed in coordination with international financial hubs. The central bank then converts these dollar reserves into domestic dinars to fund government payrolls, public infrastructure, and national expenditure. Therefore, the long-term sustainability of any official exchange rate benchmark depends heavily on three key structural variables: global crude oil prices, total daily petroleum production capacity, and the speed of domestic financial sector modernization. When global oil prices are elevated, Iraq builds substantial foreign currency reserves, providing the central bank with ample firepower to defend its official exchange rate target. When oil prices drop or OPEC production quotas contract, state revenues diminish, placing greater pressure on central bank reserves if the bank seeks to maintain a strong exchange rate peg. In addition to commodity dependence, long-term stability requires comprehensive reform of Iraq's domestic financial architecture. The Iraqi government and the central bank have repeatedly stated their long-term commitment to reducing the nation's reliance on physical cash transactions. Efforts to expand electronic payment systems, distribute point-of-sale terminals to merchant businesses, enforce digital payroll systems for public employees, and encourage citizens to open formal bank accounts are all designed to channel capital into the regulated banking sector. As more transactions move from cash street markets into formal electronic bank accounts, the artificial demand for informal cash dollars decreases, which over time helps narrow the gap between the official exchange rate and the parallel market rate. For international observers and followers of the Iraqi dinar, it is crucial to analyze these economic developments through a realistic, evidence-based framework, rather than through speculatory narratives. Online discussions surrounding the dinar often feature dramatic theories, suggesting that a sudden, massive multiplier revaluation is imminent, or that international laws guarantee overnight wealth creation for foreign paper currency holders. Responsible economic analysis requires stepping back from these unsubstantiated promises and recognizing how sovereign currency markets actually functioned in the real world. No national central bank adjusts its currency value to enrich foreign currency holders or to align with internet rumors. Central banks act exclusively in the interest of their own national economic stability, domestic inflation targets, public debt management, and international trade balances. A central bank's decision to move its rate from 1,450 to 1,310 dinars per dollar was an exercise in sovereign monetary fine-tuning aimed at dampening inflation and managing state budget allocations. It was an incremental policy adjustment, reflective of standard central banking practices, seen across emerging markets worldwide. Furthermore, investors and market followers must remain cognizant of the significant operational, transactional, and regulatory risks associated with holding physical foreign currencies. Physical banknotes held outside the issuing nation's banking network face illiquidity risks, high buy-sell spreads charged by private money exchanges, potential counterparty risks, and regulatory shifts regarding banknote series and physical note validation. Holding physical currency in paper form yields no interest, provides no cash flow, and carries intrinsic holding costs that can erode value over time, especially when parallel market spreads remain wide. It is also vital to distinguish between official central bank announcements and speculative commentaries found on unverified media channels. When evaluating Iraq's economic progress, reliable indicators include official reports published directly by the Central Bank of Iraq, public statements from the Iraqi Ministry of Finance, statistical updates from the International Monetary Fund, project reports from the World Bank, and verified macroeconomic coverage from reputable global financial news agencies. Tracking official economic metrics, such as total foreign currency reserve levels, annual inflation rates, non-oil gross domestic product growth, and banking sector deposit growth, provides a clear factual window into Iraq's genuine economic health. In recent quarterly reporting, the Central Bank of Iraq has emphasized its maintaining of strong foreign reserve cushions, supported by consistent oil export revenues. These robust foreign reserves serve as a primary buffer, allowing monetary authorities to maintain liquidity in official foreign exchange channels and uphold confidence in the national financial system. At the same time, ongoing collaboration between Iraqi financial leaders and international banking partners continues to focus on structural reforms, including expanding correspondent banking relationships with major global banks, strengthening digital trade compliance, and modernizing national clearinghouses. As Iraq continues its multi-year economic rebuilding process, domestic stability will depend significantly on its ability to diversify its domestic economy away from single resource reliance. While oil revenues currently fund the vast majority of the federal budget, long-term currency strength requires a broader productive economic base. Government initiatives aimed at revitalizing domestic agriculture, expanding light manufacturing, developing natural gas processing facilities to eliminate energy import costs, and improving transport logistics represent the real foundational pillars that determine currency value over decades. When a central bank moves its exchange rate benchmark overnight, it demonstrates the dynamic nature of sovereign monetary governance. It highlights that exchange rate policy is an active tool used by policymakers to respond to real-time economic conditions rather than a static variable. Moving forward, market participants should anticipate that the Central Bank of Iraq will continue to make periodic monetary policy adjustments as macroeconomic conditions dictate, always weighing the balance between domestic price stability, budget execution requirements, and international compliance obligations. In summary, the transition from approximately 1,450 to 1,310 dinars per dollar stands as a clear example of independent central bank action in an emerging economy. It was executed without external legislative prompts, political resets, or speculative catalysts. It was a sovereign monetary decision engineered to address domestic inflation, streamline public spending, and adjust to evolving compliance structures within international banking channels. Understanding these economic principles empowers currency observers to view developments in Iraq with clarity, objectivity, and analytical rigor. By focusing on verified facts, central bank bulletins, and sound economic fundamentals, one can navigate updates regarding the Iraqi dinar without falling prey to unrealistic expectations or risky financial behavior. Thank you for tuning in to this update. If you appreciate factual, balanced, and research-backed financial analysis regarding the Iraqi dinar and Iraq's economy, please remember to like this video and subscribe to the channel for future updates. As a final note, Please remember that the content presented in this video is strictly for educational, news and informational purposes only, and should never be construed as personal financial, investment, or legal advice. Always conduct your own thorough research and consult with a licensed professional financial advisor before making any financial decisions.